So when it comes to bonds, just like many of you are in your equities, right? You're into the stock market, you're into ETFs, so on and so forth. But bonds has a place when you are looking for something that is more fixed income in nature. So then that's where traditionally bonds then balances out your portfolio because they are supposed to be less volatile. But in the last 2 years, we have seen quite a different story, only because we were going through the rate hikes, and now that interest rates are coming down. What does it mean in terms then of the bonds that you might have? Okay, so there are two categories of bonds here. I've listed out the obvious, and for those of you who don't know, then these are the key differences. Bonds are generally for okay, so the typical one that you are used to will be like T-bills, will be like the Singapore Government Securities, SGS, right? So these are basically monies that are being lent out either by a government agency, or a corporation for a fixed amount of return. So those of you who are familiar with T-bills, you get your interest upfront at the end of the period, whether it's 6 months or 1 year, or those of you who were in longer term SGS, like 30-year infrastructure bond, you at the end of the entire period, only you get back your capital. So in that way, people like bonds because the value at maturity is predictable. That is, my capital is, so to speak, guaranteed if I hold through the period, right? And throughout this period of waiting for my capital to come back, technically speaking, I already have a fixed rate of return. I know what that return is. Okay. So, however, when you come to corporate bonds, it's only available to accredited investors. So, who are accredited investors? These are individuals who have a net worth of 2 million and above, or annual income of 300K and above. So these are individuals that we will stay on the same slide, just the previous slide, the first slide. So these are individuals who are deemed in that way to have the financial capacity to make and lose money. Okay, financial capacity. Basically, you can tahan the loss. Okay, we know that whatever we invest, there's always a possibility of a loss, so to speak, right? But it's when you know that you are invested in something that is credit worthy, that is where your investment is safe. Okay, so it's a significant amount of money that is needed. Every one lot is 250K. So to be diversified, if you want to manage your risk, you will need huge capital to do that. Okay, so later on you will see examples. Okay, now the other thing is coupon reinvestment is not an option. You have to take the coupon as it's being paid out, usually on an annual basis. Their fees are straightforward. They are usually obtained upon buying, or if you do sell along the way to the secondary market. Otherwise, basically it's a buy fee. Just like, for those of you who got T-bills, say if you use your OA, some of the banks do charge a small fee, right? So that's a fee on buying. Now, bond funds, on the other end, are open to the retail market. You don't have to be an accredited investor. Anyone can participate in it. It is a diversified portfolio of bonds. So it is already pre-selected by the bond fund manager. We don't choose the bonds, unlike those who buy directly into a bond. I can choose to buy an SIA bond. But in a bond fund, SIA bonds could be one of the many bonds that are in the basket of bonds. So that's a bond fund. The upside with bond funds is that income comes on a monthly basis. However, the downside is the price can fluctuate should you want to sell. Okay, so the upside is also the downside in the way that with bonds, there is a fixed end maturity. It could be 5 years, 10 years, whatever, you're known upfront. But with bond funds, you can come in and exit anytime you want. But what that means is you're also subject to the price fluctuation if you choose to exit sooner rather than later. Okay, so maturity value in that way really is dependent on the chosen time of exit. If you chose to exit when bond market is good, that's where you make money. But if you choose to go into some exit at a time when bond market is bad, you could lose money even though you were collecting income along the way. Okay, the other upside is that because it's a diversified portfolio of bonds, it is easier to achieve diversification, and you are therefore not subject to singular issuer risk. So earlier on, there was a comment that unit trust can go bankrupt. It is actually very hard for unit trust to go bankrupt because it's a whole basket of equities or stocks, or a whole basket of bonds, or a basket of stocks and bonds. For it to go bankrupt, every single stock in that portfolio, every single bonds in that portfolio must go bust. So it's actually very improbable for a unit trust to go bankrupt. However, what can happen is that a unit trust may lose flavor or lose its unique standing in the market. It doesn't take, there's no traction. And from a cost perspective, it does not become cost effective for the fund manager to continue that portfolio. They may then consolidate into a similar portfolio. Okay, so it doesn't really go bust per se, but it gets consolidated. So with the bond funds, if you are one who don't mind not having the active choice, but you would rather to have a diversified basket of bonds, that is an option. Of course, then along the way, you can choose to reinvest your coupons. You don't have to take the coupon in immediately, as in to have it paid out if this is not the time period that you need cash flow. Okay, so reinvestment always has its advantages, especially when, say, if you had entered when a bond market was down, there is also potential capital upside. Okay, now the downside then, of course, is there will be ongoing management fees because this is a basket of bonds that is being professionally managed. Okay, unlike a bond, singular bond where you just buy and then you hold it, I mean, basically it's for you to manage. If the creditor, if the issuer or the company that issues that bond starts to have some credit question mark or credit rating question mark, it is onerous on you to make that sell before it goes bust. Okay, so for bonds, it is possible to go bust. For bond funds, very unlikely. So the classical bonds, like if those of you who, or even stock for that matter, if you remember HyFlux, okay, when HyFlux goes bust, basically whatever stock bonds, senior bonds, whatever they have been issuing, everything goes along with it. So when you are concentrated in a bond, there is possibility of going bust. With bond funds, because it's a whole basket, less likelihood of that happening. Okay, moving along to the next slide. So as mentioned, there are three common bond types. It can be issued by the government, like we have Singapore government or the US Treasury. It also can be by government agencies. For instance, HDB can be issuing a bond fund, a bond. There could be corporate bonds like DBS, OCBC, CapitaLand, so on and so forth. So basically, these are bonds issued by companies, right? Now, if we could just tap on. So a lot of times when people think of bonds, what they're after is yield. How much can I get out of this on an ongoing basis in such a manner that it can help me with my cash flow, or in that way, earning my interest along the way? Yeah, Amy, could you just tap one more time? Yeah, so the question is always, is higher the yield, the better? This is where I want to caution and highlight that a lot of times the yield is also a question of duration of investment, because bonds by its nature, by right, whatever you put in, if a bond itself, right, at the end, you get back only the capital. And the interest or the coupon is something you know along the way. With bond funds, however, if you buy in the bond down market, there could be capital upside. So if you are able to stay invested till when bonds is having the heyday again, that's where you could have capital upside on top of the coupons or the dividend yields that you are collecting. Now, the other thing is the higher the yield doesn't mean the better the bond. Oftentimes, higher yields are issued because the credit rating of that company or that particular agency bond is lower. So high yield bonds in the market, for those of you who are more savvy, you will understand that the old term for it is actually called junk bonds. junk bonds because they are of not a good credit rating. In fact, some of them could fall into highly speculative. These are the ones that could go bust. But investment grade bonds often then will have lower rate of return or lower coupon rates. It could be like 2%, 2.5%, 3%, because there is certainty of you getting back of your money. So it's those that may not they are giving you higher yield only because you are taking on a higher risk to leave your capital with them. Because remember, bond is a loan to the government agency, or the company that's issuing the bond. All right, next slide. So managing downside risk of bonds is important. So is bonds or bond funds better for you? This is a question that will arise if you are an accredited investor. For those of us who are not accredited investors, bond funds will be the only way if you want to participate in bond market, other than government bonds, of course, because it's low bar of entry. But in terms of corporate bonds, because they are only open to AI customers, accredited investors, then the base amount, right, is 250,000 per lot. Liquidity may be an issue. So meaning to say, along the way, if you choose to sell, there must be an active secondary market that is willing to buy over. So just like stock, why are you able to trade easily and daily? It's because there's always a market that wants to buy. With bonds, they may not be as liquid. And of course, then for the longer the period you hold, then the longer you're subject to issuer default. So to manage the downside risk, it is important that you do your homework as to what is the credit worthiness of this company or the government that is issuing the bond. Because if they are not, then you may find yourself, taking coupons along the way, whether it's at 4%, 5%, 6%, but at the end of the day, not having your capital back. Now, with bond funds, on the other hand, the downside risk is the fluctuating prices. And the way to mitigate that is you need to have holding power to exit when bond markets are having its heyday rather than when bond markets are down. Then when you have that, basically throughout the period, you just focus on collecting the income. Okay, so that is the way to mitigate. Next slide. Okay, so now this is an example. Okay, sorry, there is this Morningstar thing sticker that just stuck in the middle of that. Just pardon me for that. I didn't realize. But you look on the first column. Okay, that's on our left as we look at the screen. You will see that there are names of organizations. So these are your bond issuers. Okay, like Ascot, like AIMS, like Astria, that's the Temasek related, right? Then there's ANZ Bank. There's Barclays, like so on and so forth. You read down there at the bottom, you see OCBC, Olam, and all that. Now, this is a screenshot where someone's bought the bond, they're trying to sell the bond midway through. So if we take the example of the last line, OCBC Limited, you will see that actually the bond is till 10 September 2030. And actually that bond rate is only 1.832%. Okay, that's how you read that. Versus you read the one above it, OUE REIT Treasury. That one runs till 2nd June 2026. And it's giving a coupon yield of 3.95%. That is if you have bought it at the beginning. Now, if along the way, now somebody is trying to sell, if you then got it at the ask price is basically, whoever, okay, your bid and ask, right, basically is your buyer and seller, right? Then that's where the yield may differ from the original bond issuance, okay? But basically bonds, as you see here, is a very definite period of time with a very clearly stated rate of return or coupon rate. Okay, now next slide. Bond funds, on the other hand, you will not see such details because these details are actually reviewed, analyzed, and assessed by the fund manager who then creates this basket of bonds. Okay, oftentimes then what you see is the investment objective. What is this bond fund trying to achieve? So oftentimes it's to maximize return, right? But to create what? In this case, this particular bond fund is to create capital appreciation as well as income. right? Now, if you click again, and you see that they are focused on what investment grade debt securities by governments, agencies, and then, corporations, right? And this is across, largely across Asia. So you will see here, it's no longer a singular bond. It's a basket of bonds, and the basket of bonds can go across regions, across countries. Okay. It could also cut across the three typical bond issuance, whether companies, government related, as well as government. Okay. And oftentimes they usually hold some cash. You see the credit rating of the basket of bonds. Anything that is BBB and above, or BB and above, basically, you will see is investment grade. BBB and above is investment grade. What is below, then you see is a very small percentage that is, so to speak, maybe having a certain level of a higher investment risk. Okay, but it's a small percentage. All these are actually managed by the fund manager rather than us choosing. Okay, tap again. You will see here also, typically, they will show you what the top 10 holdings, that means the top 10 holdings at this point in time, which are the top 10 heaviest weighted bonds. So you see there it's a mix of government-related, government, so you see like US Treasury there, and also corporations. Okay, and you see, because the percentages of each of these top 10 holdings are small, so you can imagine, right, if one of them goes bust, actually it doesn't affect this portfolio a lot, because in this case, it's very well diversified. Okay, some people like it, some people don't. For those of you who want to participate in something that earns you more than nominal interest rate, or more than 2.5 for that matter, and yet not be subject to high risk, this kind of distribution could work very well for you. But if you're someone who is you're willing to take more risk, you may find this is like such a yawn, right? 2% over. I mean, even if it makes me money, how much can it make? And that's where, if you're a accredited investor, buying bonds may be the way for you. Now, if you tap again, you will see the other thing is with corporate bonds or government bonds, you see a lot of times is needing cash. T-bills was an exception, right? Where you could use OA, you could use SRS. But in most cases, corporate bonds are all cash. There's no option for SRS or OA. Bond funds, on the other hand, allows so. So if a person wants to participate in corporate bonds, is not an AI customer, doesn't want to use cash, but has a lot of money in OA and wants to grow more than 2.5 because SA is going to be taken away from you from 55, this could become a possible option. Okay, next slide. Okay, so bonds versus bond funds, which is right for you? At the end of the day, it boils down to these few things in summary. It's not just about yield, right? Because remember, higher the yield doesn't mean the better the bond or bond fund. The higher the yield often means because you are actually undertaking higher risk. Okay, so what will make the difference between bonds or bond funds would be, what is your capital quantum? Because if it was not big enough, number one, you can only end up possibly buying only one fund or two funds or three funds or four funds, and four bonds. I mean, four bonds will already add up to $2 million, right? So if you have 2 million, would you rather park in four bonds only or have a mix of bonds? Then that's where bond funds come in. But if we don't have 2 million, what we have is 200,000 or 20,000, then bond funds would be the only option. Duration becomes important too. Every bond has a certain duration. So in order to really have the full yield as first, made known, you have to stay through the whole period. Now with bond funds, it's more liquid, so you could come in and out, and not necessarily have to stay through a particular duration, simply because it's a basket of durations and the manager then manages it. You just participate in it, so you could come in and out anytime. So downside risk protection is also different. With a singular bond, you're subject to what happens to that company. So case in point, I had a friend, this happened like, I think about 10-ish years ago. She was invested in this particular corporate bond. It was actually her children's education funds. Okay, children are now graduated and just started working, but back then It was her money, 250,000 in a single corporate bond that was invested for her children's education. The company went through some investigations. The entire thing was held in limbo. She wasn't sure if she will lose the entire sum or not. And that means there goes her children's education fund. Good thing was, after a few months of investigation, they found out that it was okay. They cleared the company, and so the bond was not at risk. Same thing if you look back at 2020 when COVID happened. If those of you who ever had bond experience or were looking at the corporate bond market, SIA bond at that point was going at 80 cents. Typically bond, okay, I mean, if we use $1 right, as a basis, right? Typically bonds, we say you start at a basis of $1, you take back your dollar, right? But then you get your coupon along the way, which could be 40 cents or I mean, as in 4% or whatever that percentage is. But at that point, because of COVID, everything was going to be no flying, no nothing. Actually, the bond price fell. So if you had picked it up then, by the time the bond, if SIA didn't collapse and the company stayed on, they're able to fulfill the bond, actually what you will have gained is not just the coupon, which is the yield, but your overall total return will include a capital gain from 80 cents to $1. Because at maturity, capital comes back, which is that dollar. Okay, so the question is, do you know enough to then take the action, and would you have the accredited investor status to be able to buy it? Otherwise, participating in bond funds then would be the only option. Now, if we could tap again, Emin. So just some final notes before we go to a bit of Q&A. So asset allocation, you should need to look at bonds or bond funds as a asset in a whole investment portfolio that you have, right? Of course, the purpose of it is to create some stability because the income, so to speak, is known. So it is suitable for people who are looking for regular income. But regular income doesn't necessarily mean guaranteed income or guaranteed return on capital. If you buy a bond, the coupon is guaranteed. You buy a bond fund, that rate of return may vary because if let's say it was a down market and they are not able to upkeep that return because some of the companies or the in there or they've matured and they need to reinvest and you're reinvesting in a lower environment, then that's where there may be a slight change in the yield. It might come down a little, right? So regular income also does not therefore necessarily mean guaranteed return on capital, because if the company goes bust, there goes our capital. And for bonds, in the case of bond funds, if you decide to sell when market's not so great, that could also mean capital loss. Now, the other thing is what cost you may not be the charges. Okay, oftentimes people are against bond funds because they say, why do I want to pay the fund manager's fees? But the fact is, if we are not accredited investors, actually bond funds would be the way to go. There's no choice of bonds. But sometimes having bonds and only paying a small fee to buy doesn't mean you'll make a lot of money too. Because if you choose the wrong bond and something happens to the company, it goes bust, capital is gone, right? So I want to make a final point here. Keep an open mind about insurance rep solutions. That allows you to buy into bonds, funds, in this particular case. Reason being, one thing the insurer can always guarantee is, at the very basic level, is capital protection on passing on. That's something that open market bond funds may not do for you. Because if the person needs, the estate is being managed and the bond fund needs to be sold, it could be in a downtime. That's not beneficial to the beneficiaries. But in an insurance rep, because there is an added layer of wrapping, capital protection is guaranteed regardless of how the bond funds do. In a case like this, if you're thinking in terms of CPF life, I just want to have a lifelong income that is more than 2.5 or even 4%, it is possible. I don't ever touch the capital. I leave it till I'm gone and leave that as a legacy. So keep an open mind, because structures can help us, much as there may be some cost involved. Yet if you understand the full works of it, you will realize that it helps in downside risk protection. Okay, so that's a remark I want to make. Then that's for you to explore further, whether it makes sense or not for you, because there's no vanilla answer to any one of our portfolios. Everyone has slightly different objectives, different preferences, different risk appetite, different time horizons, and all of that adds up to making the right decision for ourselves. All right. Okay, so I think that's very much it. Just to make a distinction between the two items. I hope this helps.
Thank you so much. I believe there are some questions. So please start firing your questions now. Like I said, I don't have Janelle all the time with me. I remember during the chat we have some questions. So I think one coming up is, I have heard of this bearer bonds. How does this work?
Bearer bonds. Okay. Now this is the term, honestly, that is not familiar to me.
Okay. Yeah.
So we can come back to you on that. Yeah.
Okay, so by Indra, bond fund no guarantee will always be profitable also, correct?
Any investments, not just bond fund, any investments. So in that way, profitability, I think is how you also look at it, right? So if you have a amount that you set aside as forever, I don't need to touch this capital. I just want yield. I just want cash flow. I want something that gives me 4, 5, 6, 7%. It is possible. Price may go down, as in bond fund price may go down. But because I'm going to hold to the end, and this is where the insurer rep actually is powerful. The full capital will go back to your estate. But along the way, while you live, you have been earning that 6, 7, 8%. Now, is that profitable? To me, it's obvious, because I get capital back. Just like a bond, I will get capital back at the end of the day. But this capital is like a perpetual bond. It has no end until I die. Okay, so in that way, you'll be profitable. But if, let's say, I only have a time horizon of 5 years, and after collecting the coupons or the dividends for 5 years, I decide I want to sell, and that 5th year was a bad bond market, bond prices are down, bond fund price is down, then I will lose. I could lose, because after adding all the coupons I've taken, all the dividends I've taken, it could be a negative still. So yes, like with any equity investments, bonds or bond funds in this way is no guarantee.
Okay, then he added, so coupon only 2% cannot be inflation. Over time, the money will be decayed, reduced by time.
Yeah, it's true.
Okay.
That's true. So I think, like, if we look at T-bills, right, there's a reason why once it falls below 3%, people are not very interested anymore. It's to your point, because long-term inflation is about 2.5 to 3. If I don't beat more than 3%, actually it's not very helpful for me in the long run. But of course, T-bill is a bit different. It's very short-run money. It's short-term money. Short-term money, you only compare with nominal interest rate. If my nominal interest rate is 0.5, 0.05, even 2% is very good, right? But if I think longer term, if it's not repeatable, T-bills is only good for this period of time, then as interest rate goes down, T-bills rates go down, then I no longer have this as an option. So then what are the other options? That's where bond funds actually are going to gain traction in the market. In fact, in the last 1 year, bond funds have actually risen quite a bit. Simply because people are seeing the interest rates coming down. They need to get into bond funds where there are bonds of longer duration that were already secure. So that's where bond funds can help. Do you recommend DCA into bond funds? Is that the next question?
Yes, it is. Yep.
Okay, so DCA is dollar cost averaging. It really depends, because if in today's environment, bond funds are expected to gain traction, to rise. Why? People are there is, like, let's just take T-bills for example, right? Because it's falling, right? I need to find somewhere where it's low risk but gives me better than that. So bond funds are being looked into. Now, because of that, bond fund prices will start to rise. DCA it's not helpful in a rising price environment. So just like you buy stock, if the stock keeps going up, you keep DCAing up, then you are buying higher and higher. But if it's a falling price, I want to accumulate, then DCA works. DCA works best in a falling rate environment, not a rising price environment. So if my bond fund price is rising, actually you're better off doing a single investment rather than to DCA. Yeah, certainly. There's no point in investing anything that doesn't beat inflation, of course. So that's why 2.5% OA or SA 4% for that matter is powerful, right? It's compounding over time makes a lot of difference. Generally, bonds or bond funds, most bond funds in general will give about 4 to 5%. There are bond funds that give higher. But then that's where it may or may not suit everyone.
This is a slide, right?
Yes, yeah.
Okay. Janelle, you want to comment? There's a question by
what was
Arvin.
that? Oh, sorry. Can you go to the slide with OCBC bond? Okay. Which is a slide with a coupon of 5% and price less than. Yeah, okay. So yeah, if the price is less than 100, right? Actually, technically speaking, there is a potential gain because what you will get back at maturity is the capital, which is the 100. So you're right. This would be a potential. In fact, when the SIA thing happened, right, I looked at it and said, wow, if I would enter then, I'm guaranteed, because remember it's 0.8 versus a dollar, I'm guaranteed a 20% increase on that bond on top of the coupon. So yes, anything less than 100 is a capital gain.
If SIA don't collapse,
Yeah, provided issuer, yeah, so SIA, we all know the story, right? Because Temasek saved the day. If Temasek didn't save the day, SIA was gone, all of that bond fund was gone. All of that bond money will be gone. Yeah, so everything is subject to the issuer risk. So then we need to ask ourselves, why is it that the price is below 100? And then that's where your homework as an individual investor, if you're buying a singular bond, you need to do your homework to say, what is causing this below 100? Because it's not normal. Yeah. Okay.
Okay, any other questions? Any other questions?
I just want to carry on from this. I mean, for us, we see OCBC as one of the strong components of Singapore's, stock exchange. And I can't see the rationale where something like Olam, and OCBC are almost like on a par.
So you see, it's always up to the issuer to issue what they think will attract investors. But we as investors may look at it differently. If I have to choose between OCBC and Olam, which will I choose? I think the answer is clear. Like to your point, I will choose OCBC, right? Because it's a surer thing than Olam. So like being like, I will go for OCBC. So you're right. So in this case, it's pretty unusual. So I think the key thing is because we are in an information-rich environment, we can check the news to make sure that there's nothing adverse. So long as there's nothing adverse, this is an opportunity.
Yeah, I think the difference I see here is the maturity date. So basically OCBC has a longer
One could be
maturity
nearer.
date. Yeah, Olam one is actually nearer. Yeah.
Okay, so maturity dates can have effects definitely on the price, right?
Yeah.
Because the longer you need to stay invested, let's say it's for 20 years or 30 years, not everybody is willing to do that. So then the person who's trying to sell may have to price it lower in order to have a buyer.
Okay, great. Any more questions for Janelle? So I remember there were quite a bit of interest in bonds or at least bond funds. Any last questions before we let her go?
Okay, just as a note, right? Those of you who are AI accredited investors and you wish to obtain bonds, from time to time you will see in the news in terms of which company, for example, is issuing something. The other way is actually to look into some of the platforms that sell bonds. Okay, so it's open market, you can buy bonds directly. Okay. Whereas with bond funds, you have an option to buy open market, or if you want capital protection on passing on, then you have to go to some insurer product that carries that particular bond fund. Okay, so that's the difference in terms of where you can purchase.
Here, there's a question by when should we invest in dividend stocks rather than bond funds? Both are for income.
Amy, you want to take this one? Okay.
I will always
Because
say
I think this one will be quite mixed view. Okay.
I will always say diversify lah. I mean, of course, if let's say you have enough money to spread, it's a diversification is always the more the merrier lah. Yeah. So
Okay,
that's
so
my point. Yeah.
yeah, the primary thing, if you're talking about just dividend, right? Honestly, between a dividend equity fund, say versus a bond or bond fund in that way. I mean, of course, we don't talk about bonds because bond is a singular risk, So we talk about both diversified. Then a dividend equity fund, dividend paying equity fund versus a dividend paying, therefore, because of the coupons, right? Bond fund. The difference is the potential capital upside. So of course, equities, that's where there may be a higher potential capital upside. So it really depends on your investment objectives. Okay. Then AI certification, usually it is for 2 years. Then you need to redeclare and demonstrate proof to show that net worth is above 2 mil or annual income is more than 300K.
There's a question.
Okay.
Yep.
Yeah, with bond funds, is there an entry fee and ongoing? Okay, ongoing management fees with any funds is always built into the net asset value price. Okay, so it's already built into the price. There's no entry fee per se, but depending on the platform you choose to buy, there's usually a sales charge. Unless, like, let's say some of these platforms, let's say you're doing DIY. Some of these DIY platforms actually, then it's the platform you're on, how they charge, okay? Or sometimes they are running a promotion for a certain bond fund with this particular asset management company. Then for that period, you could have no sales charge. So that, so to speak, the entry fee, there's no sales charge, okay? They usually sell, there may be a small fee also if it's DIY. That's if you buy on the open platforms yourself. Through the insurer, then because the insurer is wrapped, right? The insurer wraps the product with a death benefit that guarantees capital. That is usually a policy fee that comes with it. So that's the difference.